Hello and welcome. In this video, we will learn about the small players of the stock market. Alright. Now, the stock market has different types of participants or what we call players. And by players, I mean people or institutions who buy and sell shares in the market. They are the ones who keep the market alive by buying when they expect the price to rise and by selling when they think it might fall. Alright? Broadly speaking, these players are of two types: small players and big players. In small players, we have investors, traders, arbitrators, and hedgers. In big players, we have institutions like mutual fund houses, FIIs, DIIs, insurance companies, banks, and hedge funds. We will talk about the big players in detail in the next video. Okay? The small players are the ones who have a limited amount of capital to buy or sell shares. Usually, individuals or retail investors like you and me. Big players, on the other hand, are institutions or high net worth individuals with huge financial resources. They can move the market simply because of the amount of money they invest. Alright? Now, in reality, arbitrators and hedgers are big players. But then we can also do arbitration and hedging, and so I have included them in the classification of small players. So let us start with the first two small players, the investor and the trader. And then we will move on to arbitrator and hedger. Okay. Now on the left side are the qualities of an investor, and on the right side are the qualities of a trader. I and you can be either an investor or a trader because we are the small players with limited money. Which one we become depends entirely on our goals, mindset, and approach to the stock market. Okay? Now, an investor wants to be in the stock market for a long time. When an investor puts money into a stock, he or she is not expecting overnight profits. The idea is to let the money grow gradually as the company grows. A trader, on the other hand, wants to make quick money. Traders are not patient enough to wait for years. Their focus is on short-term price movements. That is, buying when prices are low and selling when they rise, sometimes within minutes or hours. Okay. An investor wants the business itself to grow. Why? Because When the company grows, earns more profits, expands into new markets, increases sales, then the value of its shares also increases, and so does the investor's wealth. A trader, however, doesn't care about the business. Traders do not worry whether the company is making profit or loss. All they care about is price movement. If the price goes up, they sell to book profit. If the price goes down, they may short sell or buy again at a lower price. They can make profit both ways as long as prices move. In short, traders love volatility, that constant up and down movement in the market. Next, if a person wants to invest in a company for a long time, he needs to learn fundamental analysis. Fundamental analysis is the process of understanding the company's true worth by studying its business, profits, debts, assets, management, and future potential. An investor studies things like how much profit the company is making, how much loan or debt it has, what is the market share, who are its competitors, what are its growth opportunities, what is the management reputation, what is the dividend policy, and so on. Alright? Basically, the investor tries to find out if the company is financially strong and sustainable in the long run. Okay? Whereas a trader, as I said, doesn't care about all these. He doesn't do fundamental analysis. Instead, he does technical analysis. Technical analysis involves studying charts, indicators, and price patterns to predict how the stock price might move in the future. Using various tools, traders try to time the market. That means buying and selling at the right moment to capture profits. Okay. Next, an investor is interested in things like bonus shares, dividends, rights issues, and stock splits because all these help grow his wealth. You know what dividends, bonus shares, rights issues, stock splits are, correct? All these benefit long term investors. Whereas a trader, on the other hand, is not much concerned about any of these unless the events of giving dividends, bonus shares, rights issues, and stock splits impact the stock price movement. For example, when a company announces a large dividend or a stock split, prices may fluctuate due to market sentiment. And that is when traders get activated, or that is what the traders are interested in. Okay. Next, an investor generally buys stocks or shares of companies and holds them for a long period. Whereas a trader, however, can trade in stocks, futures and options. Futures and options are collectively known as derivatives. Okay? Do not worry too much about derivatives. Derivatives are financial instruments whose value is derived from an underlying asset like a stock or index. Okay? Trading in derivatives allows traders to profit even when the market is going down through strategies like short selling or buying put options or selling call options. All right. These topics, futures and options, are quite advanced, and so do not worry about these right now. Okay. Next, an investor is happy when prices move gradually upward over time. They do not panic if prices fall temporarily because they believe that over the long term the company's value and hence the stock price will rise. Whereas a trader wants the prices to move up and down frequently. That is how the traders make money, buying low and selling high, or selling high and buying low. If the market becomes flat, meaning no price movement, traders cannot make profits. Okay, of course, if the market is flat, they can make money in derivative segment, but let us not go into that. Okay. So these are the features of investors and traders. People with a small amount of money, people like you and me, can either be investors or traders depending on our mindset, patience and knowledge, and of course goal. All right. Next, let us learn who an arbitrator is with an example. Okay. Let us say that the shares of Tata Motors are being traded at 400 rupees in the NSE and at 410 in the BSE. NSE and BSE are stock exchanges, and you know that, right? Let us assume that in NSE, one share of Tata Motors costs 400 rupees, and in BSE, one share of Tata Motors costs 410 rupees. Okay. Of course, the price gap will not be this much. This is highly exaggerated to make you understand the concept. But let us say that it is 400 in NSE and 410 in BSE. Okay. Now, just like you can buy apples from two shops at different prices, you can buy shares from either NSE or BSE. Okay. So, if Tata Motors is 400 rupees in NSE and 410 in BSE, an arbitrator can buy, for example, 1000 shares from NSE at 400 rupees each and then simultaneously sell them in BSE at 410 rupees. 410 rupees each. For example, assume that you are buying 1000 kg of apples from one shop at 400 rupees per kg and then selling it in a mall at 410 rupees per kg. Okay? And by doing this, you make 10 rupees per kg profit, correct? So an arbitrator in this case makes 10 rupees per share instantly. This is what arbitrage is. It is taking advantage of price differences for the same asset in two different markets. Okay. In real world, however, the difference in prices is usually very small, maybe a few paise. For example, this is a screenshot from Zerodha. This is Tata Motors in NSE. Nothing is written here, correct? So this is from NSE. This is Tata Motors from BSE. BSE is written here. And you can see the price of Tata Motors share in NSE and in BSE here. And you can see that there is a 5 paise difference between these. Alright. This difference occurs due to factors like market demand, trading volume, order execution and liquidity. Okay, order execution time and liquidity. But what professional arbitrators do is they use high speed trading systems and algorithms to spot and act on these differences in milliseconds. It is not as easy as it sounds, because when you buy in large quantities, the demand goes up and the price may go up too. Similarly, when you sell in large quantities, the supply increases and the price may go down. So profits often get adjusted automatically. And that is why arbitrage opportunities don't last long. But then still, arbitrators, often large firms, keep scanning markets for these small opportunities and make consistent profit with large volumes. Alright, but that is what they do in essence. They buy from one shop and sell in another simultaneously. Okay. Next, let us move on to the fourth player, the hedger. A hedger is someone who tries to protect himself from potential losses. Okay. And the process is called as hedging. For example, let us say that you are an investor and you have stocks worth 1 crore rupees in your portfolio. You have done technical analysis, and according to your technical analysis, you think that the market will fall in the next 2 weeks, and you feel that your portfolio may go down to 70 lakh rupees. This is what your analysis says. Okay, it may be right, it may be wrong, but let us not worry about it. According to your analysis, you feel that market will move down in the coming 2 weeks. Now you have two choices. First one is to sell all your stocks of 1 crore rupees now and then buy them again after 2 weeks at a lower price when the market has gone down. Okay. Now this option is not ideal because there are brokerage charges, taxes, and the risk that prices might go up after you sell. Okay. The second option that you have is to hedge your portfolio. Okay. Meaning you can sell futures, stock futures, you can sell call options, or you can buy put options. These are derivatives. Okay, do not worry about these right now. But these are some of the things that you can do to protect your money. Alright. Now, if the market falls according to your analysis, then your portfolio loses value. This will come down. But your hedging position gains, meaning you will earn a profit here. And this will balance out the loss. Okay. But if the market rises, meaning your analysis goes wrong, then your hedge will lose value, but your portfolio gains, again balancing things out. So by doing these, you protect your portfolio and reduce the overall risk. Okay, this is called hedging, and the person who does it is a hedger. Alright, hedging and arbitrage are usually done by people or institutions with large amounts of money. But then we can do it also, we can do them also, and that is why I have included them in the category of small players. Alright, so there are four main small players in the stock market. First is an investor who invests for the long term. Second is the trader who buys and sells frequently for short term profits. Third is the arbitrator who profits from the price differences between markets or exchanges. And the fourth one is a hedger who protects his portfolio from potential losses. Alright.